You awaken, you glance at your phone, and somewhere, quietly, you got poorer. Not because you spent money, not because you invested badly, but because the math moved and you didn't. That's the part nobody likes to say out loud. The math is difficult, and it doesn't care how hard you work. The setup is as shown. For decades, the deal felt simple: work, save, invest, retire. But something changed. Wages did not keep pace with inflation. Assets rose faster than prices, and debt rose faster than everything. It didn't happen overnight. It took place quietly, gradually, logically. And if you don't understand the arithmetic behind it, you'll think it's bad luck. It's not luck, it's math. Let's begin with inflation. Let's say inflation averages 3% a year. That seems minuscule, harmless, almost polite. But 3% compounded over 25 years doesn't mean things cost 75% more. This indicates that they cost more than double because compounding does not develop in a linear fashion. It curves. Now raise that to 5% inflation. Over 25 years, prices more than triple. No drama, no headlines, just arithmetic. You lose 3% of your purchasing power each year if your income rises at 2%, while prices rise at 5%. That loss compounds too. Brutal. Now let's layer in housing. A house is more than just a home. A leveraged asset, it is. If home prices rise 6% annually and you put 10% down, your actual return on cash can look enormous. That's because debt magnifies gains. However, here's the twist. You are on the other side of that leverage if you do not own the asset. Rents rise with prices. Mortgages get harder to qualify for. Down payments grow faster than savings. The same math that builds wealth for asset owners quietly builds pressure for everyone else. It's symmetrical and ruthless. Zoom out. Governments borrow a lot. Debt expands. The interest rates are set by central banks. Markets respond. When rates are low, borrowing is cheap. The prices of assets rise. Stocks go up. Real estate climbs. Risk appears to be smart. When rates rise, the reverse happens. But here's the uncomfortable part. The system prefers inflation. Why? Because debt is reduced by inflation. If a government owes $1 trillion and inflation cuts the real value of that debt in half over time, that burden becomes lighter. Not morally lighter, mathematically lighter. Therefore, the motivation is not always to safeguard your savings. It's to manage the debt, and those are not the same objective. Now let's talk about wages. Over the past few decades, productivity has significantly increased. Technology improved that, efficiency improved, output per worker improved. But wage growth didn't mirror that productivity growth at the same rate. Instead, a larger share of gains flowed to capital, stocks, equity, ownership. If you own productive assets, you ride that curve. If you only sell labor, you negotiate against it. Again, not conspiracy. Arithmetic. Capital compounds, labor bargains. One scales without sleep. The opposite does not. Let's introduce compounding more directly. If you invest $10,000 at 8% annual returns, in 30 years it becomes over 100,000. That feels like magic. However, the other side is just as potent. If you carry a credit card balance at 20% interest, that debt can double in under 4 years if unpaid. Same formula, opposite direction. Compounding is indifferent. It will build your wealth. Alternately, it will speed up your decline. It has no regard for your side. Now combine inflation, asset inflation, wage stagnation, and consumer debt. You begin to comprehend everything. Your savings account yields 1 to 2%. The rate of inflation is 3 to 5%. Assets inflate at 6 to 10% during strong cycles. Interest rates on credit cards range from 18% to 25%. In isolation, each percentage point appears insignificant. Together, they create drift. And drift over decades becomes distance. That's why two people earning similar incomes can end up in radically different financial positions. Not as a result of genius, because one aligned with the math earlier. Public hype tells you to chase the next big thing, the following stock, the next crypto surge, the next real estate boom. It's loud, exciting, addictive, but the underlying reality is quieter. The majority of long-term wealth is not built on huge returns. It's built on avoiding catastrophic math, avoiding high-interest debt, avoiding forced asset sales, avoiding lifestyle inflation that locks you into fixed costs. The real game isn't about hitting home runs. It all comes down to avoiding negative compounding. That's less glamorous and far more effective. There's also a psychological layer. Humans are linear thinkers. We expect tomorrow to look like today, just slightly more. However, financial systems change rapidly. Over the course of 40 years, a difference in outcome of 2% in annual return can amount to hundreds of thousands of dollars. 2%. This is less than the majority of annual salary negotiations. However, over time, it completely redraws futures. The math is brutal because it magnifies small decisions repeatedly. Now consider demographics. As populations age, fewer workers support more retirees. That pressures public pension systems. The cost of healthcare goes up, tax bases strain. Governments respond with policy adjustments, higher taxes, reduced benefits, inflationary measures. Pressure is redistributed in some way by each solution. Again, incentives follow arithmetic. If obligations exceed contributions, something must adjust, and adjustments rarely feel fair when they land. So, where does that leave the individual? You can't control inflation. You can't control central bank policy. Demographic shifts are beyond your control, but you can choose which side of compounding you stand on. That choice doesn't require brilliance, it requires clarity. Have assets that add value, reduce the number of high interest debts, understand real returns after inflation, not just nominal ones. Because even though real purchasing power slowly decreases, small gains can feel impressive. That's one of the crueler illusions in finance. The numbers are bigger now. However, those numbers sell less. And here's the irony. You may not be the target of the system's destruction. It's designed to continue, to sustain growth, to manage debt, to keep things stable. Policymakers may accept that trade-off if inflation gradually reduces savings while preventing systemic collapse. It is effective from a macro perspective. From your perspective, it may not, and that tension is permanent. Over the next 10, 20, 30 years, the pressure likely intensifies. More global debt, more volatility in rates, more competition for assets. Technology may further boost productivity. AI may displace certain jobs. It's possible that capital will expand even further, which raises a quiet question. Where does bargaining power settle if labor does not scale infinitely and capital does? The math suggests one direction. History suggests friction. This isn't a call to panic. It's a call to look at the scoreboard honestly. If your money grows slower than inflation, you're shrinking. If your debt grows faster than your income, you're compressing your future. If your investments compound steadily while you avoid negative compounding, you gradually separate from the median outcome. Not because you outworked everyone, because you respected the arithmetic. The math is brutal, but it's also predictable. Predictable systems, on the other hand, reward those who grasp them early. So the real question isn't whether the system is fair, it's simpler. In a world ruled by compounding forces, you can't stop. Which side of the equation are you standing on?